Over 93% of traders lose money in the markets, not because of the market, but because of their mindset. Hi, I'm GC Sharma, founder of Ghar Ghar Investor, former head of financial education at the National Stock Exchange. After 3 decades in the markets, I'm here to help you trade with discipline, not emotion. Welcome to Bounce Back Trader, India's free YouTube learning series for traders who want to bounce back with clarity and confidence.
These days, almost every trader has a WhatsApp group where people share trading tips. And the interesting part is that traders often forward only those messages that support their existing belief. For example, if someone has bought a stock, they will search only for news that talks positively about it. They will ignore the negative news. This is the power of confirmation bias. The mind likes to hear only what it already believes. That's why WhatsApp University and YouTube videos often become poison for traders because they only show one side of the picture. Confirmation bias is a psychological trap where a person accepts only the information that validates their belief and ignores or rejects anything that goes against it. In trading, this means that if you are bullish on a stock, you will only focus on bullish articles, experts, and indicators. You will ignore the bearish signals or assume they are wrong. The problem is, the market runs on reality, not on your comfort zone. And when a trader doesn't adapt, they lose to the market. Another problem is that traders also seek advice only from friends or peers who agree with them, and this traps them in an echo chamber. Behavioral finance studies have repeatedly proven that confirmation bias damages decision-making. One research found that traders who only read material supporting their beliefs performed 20 to 30% worse than traders who actively challenged their beliefs. Another survey revealed that 70% of retail traders, when in a loss, searched only for information that gave them hope, instead of facing reality. This is dangerous because instead of cutting the loss, they let it grow bigger. In India too, an NSE survey showed that most retail option buyers extend their stop loss only because they get hope from WhatsApp groups, and what could have been a small loss often turns into an account wipeout. The human brain naturally prefers staying in its comfort zone. Once you've made a decision, everything that supports it feels right. The reason is evolutionary. The brain avoids conflict and seeks certainty. But in trading, certainty means danger. The market is dynamic. The trend that existed yesterday could reverse today. If you stay only in your comfort zone, you will always be one step late. And in trading, being one step late often means a big loss. Amit bought Infosys because he believed the IT sector would boom. When quarterly results came out poor, he ignored them and forwarded only those articles that said, long-term IT sector is safe. The result, his capital was cut in half. Sunita bought a pharma stock and kept searching only for positive analyst reports. When negative news came, she dismissed it as fake. But the market broke her belief. A third example is Arjun, a bank Nifty trader. When the market was falling, his WhatsApp group kept saying, "This is just a correction, tomorrow it will bounce." Arjun blindly followed that advice and lost his entire month's salary in one expiry. This shows that confirmation bias is not theory, it's a real and painful trap. Successful traders think differently. They challenge their beliefs. If they've bought a stock, they consciously search for what could go wrong. Their question is, why will my trade fail? This habit helps them adapt and keep losses small. Another practice, keep people in your circle or trading group who think opposite to you. It feels uncomfortable, but that is the real growth zone. Another strategy is journaling. For each trade, write down reasons for and against it. When you write both sides, your brain naturally begins to think in a balanced way. So friends, confirmation bias is a silent killer that stops traders from accepting their mistakes. Every day, ask yourself, what evidence is against my trade? If you are only searching for evidence in your favor, know that you are in a trap. One practical strategy is to create 2 columns on a page before every trade, why for, and why against. Writing both sides makes you objective. Second strategy, appoint a trusted friend as your devil's advocate who always challenges your trades. Third, every weekend, review your trading journal and see how many times you ignored opposite evidence. Reflection exercise. Write down your last 5 trades and note how many times you ignored opposite signals. In the next lesson, we'll study another bias, the recency effect, which forces traders to take wrong decisions based only on short-term memory.
You've just completed another lesson of Bounce Back Trader. Remember, trade with discipline, not emotion. Subscribe to the channel, share your thoughts in the comments, and continue your journey in the next video. Let's change that 93% story.